Hi, welcome back. You're watching MF Corner. Joining in now is Abhijit Bhave from Fisdom Private Wealth. Hi, Abhijit. Thanks very much for joining in. So today we have chosen three high-risk products, all equity-oriented, focused funds, PMS, and Smallcase. Now, I can imagine that there are many differences, but, there is a unifying factor. So what I want to know is which is a better bet for investors on, say, a risk-adjusted basis?
So, Sumaira, thank you so much for inviting me. It's so nice to be here on this show. These three, as you rightly said, are extremely unique products. And, before I answer the question, I just want to make 2 points here. We have this old saying that don't keep all your eggs in one basket. Now, that's a mutual fund for you. That's diversification. But now there is this modern thinking that if you have eggs, put them in one basket or a few baskets and watch those baskets carefully. And that is what is Smallcase, and that is what is PMS. And as you have put on the screen now, it also depends on your investment experience. It depends on your risk-taking ability. It also depends on what is the size of your portfolio. If I am a early age investor, I have a smaller portfolio, less than 25 lakhs. It's only mutual funds, including focus equity funds. Beyond that, I want to get the excitement of investing in stocks. I go into Smallcase. And PMS is a HNI product, which means it is minimum 50 lakhs. So unless my portfolio is more than 2.5 crores, it's not right to invest in a PMS product. Now, coming to your question, it's a very important question, but the question has an answer which will not really answer the question because
Okay, do try.
We in risk adjusted return, we look at the volatility, we look at standard deviation, we look at Sharpe ratio. But the problem here, Sumaira, is that we are comparing apples and oranges. In terms of focus equity fund, there are 26 schemes. In terms of PMS, there are 400 different PMS service providers. And Smallcase, there are as many as 220 plus investment themes. So everything is actually different in terms of their objective of investment, in terms of their investment style. So it's not a straight answer. The starting point could be actually try to get similar investment objective related avenues and then look at comparing them. Otherwise, there is risk. And one, I would say that a part of your portfolio, which is the high risk portfolio, should be allocated to these products. But otherwise, it's very dissimilar, very difficult to kind of look at the investment process and even performance. For example, Smallcase only has a track record of 4 to 5 years. So you have to have one or two complete business cycles to really compare investments in terms of getting risk-adjusted returns.
Yeah, no, I take your point, Abhijit, that, they may be entirely different. But, one can imagine that one investor could have interest across the three, right? So therefore, wanted to know that, in terms of, say, transparency, expenses, there are many metrics to evaluate. So,
Yes.
For example, downside protection, which of the three you would say has better downside protection?
Now that actually you have got the right point to look at now, because equity risk is common for all of them. Risk cannot be taken away, but one can look at mitigating risk. So my clear number one here, Sumaira, is mutual funds. Mutual funds, the downside risk protection is much better. First, because of diversification, because there are a lot of baskets where you put your eggs. But more importantly, it's got a lot of SEBI regulations underlying in terms of how they can invest and a lot of documented investment process. That's where number one would be mutual funds. Now, PMS also is a large industry. There are a lot of PMS products which are which are thousands of crores. And there are PMS guidelines by SEBI. There are documented processes for risk management. And we have these fund managers who have a track record of 10 years, 15 years with the same PMS scheme. So for me, number two in terms of downside risk protection would be PMS, because they can be nimble in terms of taking exit calls. And number three would be Smallcase. I'm not saying it's a wrong product. It's the right product, but the downside protection is much better in the other two.
Okay. Yeah, absolutely. Because, many of the PMS managers were also fund managers at AMCs, right, before they moved to PMS. But, since we're in the MF show, so let me concentrate a bit more on focus funds. So this is concentrated by its very nature, right? I think the SEBI regulation says that maximum of 30 stocks can be held in the focused fund. So which type of fund would work with it? I mean, what other funds can complement a focused fund?
So there's no one side fits all approach. You also are aware of that. At Fisdom, when we construct a portfolio, we look at the client's risk profile. We look at the time horizon, liquidity, simple formula SLR, safety, liquidity, returns. Higher the return you want, you'll have to compromise on safety or liquidity or both. And what we do, summarize, we look at a core and satellite approach. Now, this is where you might find a surprising fact. Normally, a core portfolio would be a large cap portfolio, maybe a flexi cap with some large cap bias. Maybe there are a few large cap oriented PMS products also. Now, out of the 26 focus equity schemes, Umaira, majority of them have majority large cap bias. 70 to 80% of the focus equity portfolios are large cap. So for us at Fisdom, even a focus equity fund would be a part of the core portfolio.
Right.
Now, that is where you try to select a fund, not just based on past performance, because as you also would keep on saying, past performance is no guarantee of future returns. You try to look at less overlapping and less correlation with the other parts of core portfolio. So that is where I would put a focus equity fund, and the due diligence or the product selection would be like any other mutual fund scheme. On the other hand, your small case and most of the PMS would come in your satellite part of the portfolio.
Okay, understood. Okay, now, all of these are, I'll once again say it, for high risk investors, right? Yet, are there different types of investors who will benefit from investing in, either of these three products?
So, I am a great fan of this tagline, mutual fund sahi hai. Because I myself bought my first mutual fund in 1996 and sold my first mutual fund in 1996. So I'm a great believer in mutual funds. So mutual fund is a evergreen product for all kinds of investors, young, old, HNI, retail, any investor. Mutual fund has to be a core allocation. As you have larger portfolios, more experience, you have seen the risks and the ups and downs, you can stomach those. You have a larger portfolio, then comes PMS, because it's obviously a 50 lakh kind of ticket size. People who understand markets better are advised to go into PMS. Now, small case is very interesting because you're trying to get the flavor of PMS at a smaller value, and that can be exciting for people. It's not just about the science of investment, but the excitement is something that is not comparable. So somebody who has a mutual fund portfolio, 20-25 lakhs, wants to invest in direct stocks, wants to get alpha and try to see how I can taste a mini PMS, that's where a small case would come in. But as you rightly said, high risk profile, aggressive risk profile. And as I said in the beginning, Sumaira, the people who would really watch those baskets carefully, where they're putting those eggs. Yeah. So it's as simple as that.
Right. So basically, same but different. Abhijit, thanks very much for joining in to tell us, how these three products, Focus, Fund, PMS, and Small Case, stack up against each other. So I hope you guys have found all the answers you were looking for. We'll wrap up here on MF Corner.